Your mortgage didn't get more expensive by accident. Here's the paradox. Wages have been outpacing inflation since early 2023, yet millions of Americans feel poorer, more squeezed, and more locked out of basic life decisions. Buying a home, financing a car, carrying a balance. The facts are blunt. The interest on a typical 30-year mortgage now costs about $500 more per month than it did in 2019. Credit card rates are at record highs. Auto loans, business loans, everything that relies on borrowing has surged since the pandemic. And that cost hits you every single month, whether prices at the store feel calmer or not. But here's the part nobody is saying out loud. This isn't just about banks being greedy or the Federal Reserve flipping a switch. Something much bigger has been quietly shaping these numbers behind the scenes. Something that keeps showing up in voter priorities alongside inflation and affordability. Government deficits. The facts show borrowing costs rose sharply after the pandemic. What that suggests is a chain reaction most people never see until it's already drained their paycheck. And once you understand that chain, the frustration starts to make sense. Because the real question isn't why rates are high. It's why they're staying there. To understand what's happening, you have to zoom out. This wasn't a single policy mistake or one bad year. It was a pattern that accelerated fast. When the federal government runs a deficit, it spends more than it collects in taxes. To cover that gap, it borrows. That borrowing doesn't happen in a vacuum. It pulls money from the same pool of capital everyone else depends on: households, businesses, banks. After the pandemic, that borrowing exploded. Congress approved more than $6 trillion in fiscal stimulus between 2020 and 21. At the same time, supply chains were breaking and labor markets were disrupted. That combination matters, because when you inject massive demand into a supply-constrained economy, prices don't calmly adjust. They jump. Inflation did exactly that. It surged to 40-year highs, and once inflation takes hold, expectations change. Lenders start pricing in more risk. Bondholders demand higher returns. Interest rates across the economy begin to rise, not just on government debt, but on everything tied to it. Here's the reframing most people miss. High borrowing costs aren't just a response to inflation. They're a signal that the market expects more volatility, more debt, and more pressure ahead. And once that expectation sets in, it feeds on itself. So the real issue isn't whether borrowing got more expensive. It's why the system was set up to make that outcome almost unavoidable. Here's the claim that changes how this story looks. Government borrowing doesn't stay contained at the top. It leaks into your life. The evidence is concrete. In today's market, a $328,000 30-year mortgage carries roughly a $2,000 monthly interest payment. That's about $500 more per month than an identical mortgage at 2019 or 2016 interest rates. Same house, same price, just a different debt environment. That gap isn't random. When the government runs persistent deficits, it competes for available capital. More treasury bonds flood the market. Investors demand higher returns to absorb them. That extra return is called a term premium, and once it rises, it pushes up interest rates everywhere else. Banks don't set rates in isolation. They price loans based on the same market conditions shaped by federal borrowing. Notice what's missing from most affordability debates. There's endless talk about corporate behavior, supply shortages, and interest rate tweaks. Very little discussion about the scale of government borrowing itself. Yet deficits have exceeded 6% of GDP since 2023, putting sustained upward pressure on rates. This is exactly what conventional economic modeling predicts after a surge in deficit spending. And once it starts, it doesn't unwind quickly. Now watch how this quietly escalates. This is where the situation normalizes something that shouldn't feel normal at all. After inflation spiked, the central banks stepped in. Interest rates were raised to slow demand and bring prices under control. At the same time, bond yields climbed to around 4%, more than double what they were a decade earlier. That move rippled outward, Credit cards, auto loans, business financing all followed the same upward path. We've seen this pattern before, not as a textbook example, but as a lived cycle. Large deficits meet economic stress, inflation surges, rates rise to contain the damage, and then high borrowing costs linger long after the original crisis fades. What starts as emergency policy becomes the baseline. Here's why that matters. Every year these rates stay elevated. Households spend hundreds more just to stand still. Businesses delay expansion. Risk-taking shrinks. Growth slows. None of that shows up in a single headline, but it compounds quietly. This is where the story flips, because instead of addressing the source of the pressure, the political response often moves in the opposite direction. More intervention, more spending, more attempts to blunt the symptoms without touching the cause, and that sets the stage for the next escalation. Here's the stronger evidence, and it's harder to ignore. During the pandemic, Congress didn't just spend more. It authorized trillions in deficit spending, then issued a massive wave of new Treasury debt to finance it. Someone had to buy that debt. The Federal Reserve faced a fork in the road. Let markets absorb it and watch yields rise, or step in and purchase the securities itself, soaking up the supply Congress created. The Fed chose the second path. It pursued a more accommodative monetary policy instead of letting the risk of U.S. debt be fully priced by markets. The result wasn't subtle. What followed was record-breaking inflation not seen since the 1980s. That inflation then forced the Fed to reverse course and raise rates aggressively, locking in higher borrowing costs across the economy. This is the contradiction that changes how the story looks. Leaders talked about affordability while enabling policies that made borrowing more expensive for years to come. They warned about inflation after the fact, even though the supply constraints and the $6 trillion in stimulus were already in motion. Notice what they didn't deny. No one disputes the scale of the spending. No one disputes the inflation spike. No one disputes the rate hikes that followed. Yet the focus stays on treating symptoms, not the mechanism that produced them. Once you see that sequence, it's hard to unsee it, and it explains why the next moves are even riskier. Now watch how fast this stacks. Even as inflation cooled from its peak, deficits stayed high. Federal deficits have exceeded 6% of GDP since 2023, keeping pressure on interest rates instead of relieving it. At the same time, politicians began floating affordability fixes that didn't touch spending at all. More subsidies, more pressure on the central bank, more attempts to override market signals. Then things got sharper. The Department of Justice recently served the Federal Reserve with subpoenas and threatened a criminal indictment over the Fed's building renovations. On its own, that might sound bureaucratic, but in context, it lands differently. It comes after repeated political demands to lower interest rates, even as inflation risks remain. Add one more development. The president publicly announced a desire to cap credit card interest rates at 10%, framing it as an affordability measure. Price controls, not new supply, not deficit reduction, just a hard ceiling. Stacked together, these moves signal urgency and loss of control. Pressure on the Fed, intervention in credit markets, deficits that refuse to shrink. Each one alone is manageable. Together they compress the system. And that raises the question that hangs over everything now. What happens if this continues? Now bring this down to your level. When interest rates rise, it doesn't stay abstract. It shows up when you open a credit card statement and see record high rates. It shows up when a car loan costs hundreds more per year than it used to. It shows up when a business loan becomes just risky enough to delay hiring, expansion, or raises. For the median American, higher rates mean spending hundreds of extra dollars every year just on interest. Same car, same house, same balance, more money gone, and that money doesn't build equity. It doesn't improve quality of life. It simply services debt that became more expensive because of decisions far upstream. Now consider who gets hit hardest. Capping credit card interest rates at 10% sounds helpful on paper, but the facts suggest something else. When prices are capped, credit doesn't become cheaper. It becomes scarcer. Lower income borrowers, especially those with weaker credit histories, are the first to lose access. And when traditional credit disappears, riskier alternatives rush in. Short-term, high-cost, fast cash loans, less protection, more volatility. This isn't ideological, it's mechanical. And for millions of people, it feels familiar. If you felt that squeeze personally, say so in the comments, because the pressure you feel isn't accidental, it's structural. And understanding that structure is the next layer of this story. Here's the quieter insight most coverage misses. This isn't about bad intentions. It's about incentives and optics. Deficit spending delivers immediate benefits and delayed costs. Subsidies feel helpful now. Rate caps sound compassionate now. Pressure on the central bank looks decisive now. The pain shows up later, diffused across millions of balance sheets, easy to blame on the economy. The mechanism is leverage. When the government borrows heavily, it doesn't just raise its own costs, it reshapes the entire pricing structure of money. Investors demand higher returns, lenders adjust, risk tolerance tightens, the cost of time itself goes up. That's what higher interest rates really are. There's also spectacle. Focusing on visible prices distracts from invisible drivers. It's easier to talk about rent, groceries, and credit cards than to explain deficits, bond markets, and term premia. So the system defaults to treating symptoms publicly while preserving the behaviors that cause them privately. This is why affordability debates keep circling without resolving. The incentives reward short-term relief and punish long-term restraint. And until that changes, pressure doesn't disappear. It just migrates. Which brings us to what happens next. Now look ahead, because the next phase is already forming. There are two paths from here, and neither is comfortable. One path keeps going. Deficits stay elevated. Political pressure on interest rates intensifies. Credit markets get more distorted. Borrowing doesn't suddenly become cheap again. It becomes uneven. Some people still get access. Others get locked out entirely. Rates stay higher than the pre-pandemic norm, even if inflation looks calmer on paper. The other path is slower and quieter. Spending growth comes down. Deficits move toward a lower target, like 3% of GDP. Bond markets gradually relax. Term premia ease. Interest rates don't crash, but they stop climbing. Affordability improves not through sudden relief, but through reduced pressure over time. Here's the uncertainty. Both paths require political decisions, and momentum already favors the first. The longer high deficits persist, the harder it becomes to reverse expectations. Markets don't wait for speeches. They price what they see forming. This is where the next move matters most. And it's already being debated, whether voters realize it or not. Here's the insight that ties everything together. Affordability didn't collapse because life got more expensive overnight. It eroded because the price of borrowing quietly reset. When debt becomes more costly, everything that depends on time, planning, and stability gets harder. Homes, businesses, education, even everyday flexibility. This entire story can be summarized in one sentence. When government treats borrowing as painless, everyone else eventually pays the interest. The loop that's opening now is simple but powerful. As long as deficits stay high, pressure on rates remains. As long as rates remain high, affordability stays strained. And as long as affordability feels broken, the temptation to intervene grows stronger, even if that intervention deepens the problem. That's why this isn't the end of the story. It's the setup. The next chapter is about which costs get hidden, which get shifted, and who ends up absorbing them. If you want clear, calm analysis of how these forces actually move, not just what politicians say about them, follow and subscribe, because the most important changes in the economy don't announce themselves. They show up on your monthly statement,